All right. Good afternoon, everyone, or good morning, depending on where you are. Welcome to the Loan Officer Training Series with the Mortgage Calculator. We'll get started here in just a moment. Just give us a second here to go live on all the different platforms, but we appreciate you tuning in nice and early. I see some comments already coming in there in the chat. Definitely appreciate it. Feel free to keep dropping your questions in the chat. Great topic here for today. And as usual, Jose will take us through it. So it looks like we're live on all the platforms. We'll go ahead and get started. What we'll do here is get into it, but you can go ahead and keep dropping comments there in the chat. You can also drop any questions you have in the chat, and we'd be happy to answer them after the presentation. So welcome, everyone. My name is Kyle Hershey. I'm the COO of the Mortgage Calculator, joined here by our president, Nick Hershey, and our CSO, Jose Gonzalez. We are a lender that specializes in non-QM loans. Excuse me. And what we do every weekday, not every weekday, every Tuesday, Wednesday, and Thursday at 12 p.m. Eastern is our loan officer training series, where we go into a deep dive on a loan officer training topic. And today's topic is going to be evaluating borrowers' assets. So I'll go ahead and turn it over to Jose to get it started here. Again, you can drop any questions you have in the chat. We'd be happy to answer them afterwards. Go ahead, Jose.
Good afternoon, everyone, or good morning for those listeners on the West Coast. Thank you for joining us for today's training webinar on evaluating borrower assets for real estate financing. In this training, we're referring to the assets to meet the cash to close requirements, right? We're not talking about other real estate that they own, those types of assets. We're talking about assets to meet the cash to close requirement, right? So let's get right into it. So again, giving a little bit more clarification here. In a transaction, right, whether it's a purchase where you're going to have down payment, or whether it's a refi where you're going to have closing costs and reserves, especially if it's a rate and term refi and not a cash out refi. And the cash out refis, most of the times you can meet the reserve requirement with the cash out proceeds. Sometimes you cannot, and on a rate and term, depending on if it's AUS that you get findings asking for reserves, or if it's non-QM where you definitely will have a reserve requirement. On a rate and term, you definitely need to verify assets to meet the reserve requirement. So what we're specifically referring to here is the required assets to be verified for the cash to close. So we're talking about the down payment for the program selected, the closing costs, and the reserves. And as previously stated, if you're doing an agency loan, right, FHA, VA, USDA, or conventional, that's what we're referring to when we state agency, automated underwriting determines the reserves, right? You're going to run your automated underwriting, whether you use LP for Freddie Mac loans or whether you use DO for Fannie Mae loans. And in your findings, we'll let you know if you're approved, it's fine. If you weren't approved, maybe it's letting you know how much needs to be verified for reserves. And it could be that your borrower is short. So always look to your AUS findings for the reserve requirement on agency loans. And on non-QM loans, as we always like to state, right? Remember that non-QM guidelines are all specific to the option being selected. They are not homogeneous. You can't generalize across the board how to treat a non-QM loan for reserves. You do have to look at the specific guidelines for the option selected and make sure that you read the fine print on reserve requirements. Are they asking for 3 months? Are they asking for 6 months? Are there additional reserves to be added if they have additional finance properties? Are there additional reserves to be added if they're financing more than one property at the same time? I recently had one where the reserves jumped from 6 months to 10 months because the borrower had their primary finance and they were also financing 2 purchases at the same time. So the reserve requirement increased from 6 months to 10 months per transaction. So you don't want to get caught off guard with those types of scenarios. So, what are the most common asset types that borrowers could be, showing us in their application? Well, the most common, obviously, is depository accounts. We're talking about checking, savings, money market, and any other type of liquid depository account, right? Those are very liquid assets. The preferred always counted at 100% of face value. Stocks, bonds, and mutual funds are another category of assets. And for this category, you do have to review either your AUS, the selling guide, or your guidelines if it's not QM to see if they're going to give you 100% of the asset or if it's going to receive a haircut, as sometimes it is the case. Business assets, another interesting category. And here we're really referring to liquid assets that the business has, right? Checking accounts, savings accounts, money markets. We're not really talking about, buildings, inventory, or anything like that. However, in some cases, people do get a loan against the inventory to get money for work, right? So that could be something that you're faced. But typically, when we're talking business assets, we're talking about liquid assets. Sale of real property is another asset. Now, real property, we're talking about real estate, right? They could have a pending sale on a property, for example. They're going to net $200,000 from the sale. That's an asset of which you're going to have to show later a closing disclosure and the transaction history showing the money going into their account. Gifts, another interesting category. Definitely want to make sure that whoever's giving the gift is an authorized gift donor type for the transaction selected. Interested party contributions. Now, here we're talking about any person who is a party to the transaction. So that could be the seller, that could also be the realtor, that could also be the lender. Those are all interested party contributions. Typically, the one that comes into play most in interested party contributions is the seller. Retirement funds. Most people may use the terminology 401k when they're really referring to retirement funds. Could be a 401k, could be an IRA, many different types of retirement funds that are basically tax deferred investments. That's the whole thing on a retirement fund. The money is invested into the retirement fund pre-tax. So that's where the additional savings is there. You are investing your pre-tax income. It will grow, and then at some point in the future, when you do withdraw, you will be taxed, and hopefully it'll be at a lower rate because you will be older and it'll be a different tax bracket. Cash on hand, that's a very problematic asset. That's one of the ones that we have difficulty verifying. I put it on there only because you're going to face that scenario where they're going to tell you they got $30,000, but it's not in the bank. So then that's where you're going to have to scour the guidelines to see what option you can find that may not have any sourcing or seasoning of large deposits, of which there are, but those tend to be more business purpose loans, right? The SER closing in an entity where you're going to find the some options that do not source nor season large deposits. Sale of personal assets. Not to be confused with sale of real property. Real property is real estate. Personal assets could be you sold a car and that you had lying around and you got an extra $6,000 or $7,000. Well, you're going to have to show the paper trail of the sale of that car, bill of sale, transfer of title, proof of receiving the money, number of different things that you would have to prove there. Grants, another interesting category. Grants typically tend to be from government type agencies, whether it be federal, state, local, usually going to be involved with some kind of down payment assistance or income based assistance plan, where these grants will come into play. Inheritance, not to be confused with a gift. I mean, the inheritance is money you inherited, so you're just going to have to provide documentation for the inheritance, right? Is there a will? Is there a paper trail showing the money leaving the individual's account who provided the inheritance and the money going into the borrower's account? But mainly the will is going to be the important document there that's going to document the inheritance. Asset based loan, another interesting category. One of the most common examples of an asset based loan is, again, you have your retirement fund or your 401k, and you can actually draw a loan against your 401k so that you don't have to cash in your 401k. You leave it in place, you get a loan backed by your 401k, and you're actually going to pay yourself back the principal and the interest, while at the same time the investment continues in your portfolio, accruing value and interest, right? So you're not cashing in your 401k asset there and usually paying a penalty to do so. You're just getting a loan against a 401k. One of the good things to note, and I do bring this up in the coming slides, but one of the good things to note when you do have an asset based loan, like from a 401k, is that if you have enough assets to still in the account to cover the amount of the loan, then, and since it is also a secured loan on top of that, then the loan is not counted against the liability, against the DTI of the borrower. And last but not least, a very tricky category there is foreign accounts. So you are going to have to review the selling guides and the guidelines very carefully to see if assets held, and here we're talking about money, basically held in a foreign checking or savings account, can be used if it is kept in that foreign checking or savings account and not moved into a U.S. based checking account. In some cases, you will be able to use these assets held in a foreign account to count towards reserves, obviously having to show the currency exchange rate. And in other cases, any money to be considered as assets do have to be in a US based account where they can be easily accessed. Because that's the issue with the foreign accounts. They tend to have restrictions with the moving in and out of funds from the account. They may not allow the borrower to readily withdraw all of the money in the account to meet a need. So do be aware and do check your guidelines or selling guide if it's an agency loan to see how you are to treat those foreign checking and savings accounts. So let's get into the verification of some of the more common types of assets, right? The first one, the depository accounts, again, I mentioned you have depository accounts, but you also have stocks, bonds, and mutual funds, which fall into the liquid type of assets. And again, if it's an agency loan, check with your findings to see if you even have to verify assets. Many times, if it's a refi, you don't have to verify assets. Or to see if AUS in the findings is asking you to verify 1 month assets or 2 month assets. So it could be no assets need to be verified, or 1 month or 2 months. That's going to be on the findings of AUS, either LP or DO, whichever you ran. Non-QM, again, you're talking about individual guidelines for each option. And The guidelines are going to tell you either have to verify 1 month or 2 months, or in some cases, like I mentioned, where they're not asking you to verify any type of seasoning or sourcing. So again, most important here, look at the guidelines to know what you need to verify 1 month or 2 months, either with bank statements, or another method to verify the asset is with the verification of deposit. This is less commonly used now, the VOD, right? Most of the time, the underwriters are going to want the bank statements. But please note, if you do provide a VOD, then that eliminates some of the issues with all of the deposit details. But again, if you're looking to verify, for example, the clearing of an escrow deposit from the borrower's account, you're going to have to provide that bank statement anyhow. So make sure you reviewed it so you don't get any surprises when you do provide that bank statement. Some of the surprises you would be looking to avoid are conditions for large deposits. And typically, and it really depends on the loan type, what a large deposit is going to be, right? If you're talking about a conventional loan, Fannie or Freddie, usually the findings will let you know what a large deposit is, and a large deposit is usually going to be any deposit that's 50% or greater than the monthly income of the borrower for a large deposit. That's conventional only. FHA, different story. FHA, it's really up to the discretion of the underwriter, but usually any deposit over $1,000 on an FHA loan is going to be flagged to verify documentation. So do be aware when you are reviewing your bank statements what can catch you off guard: large deposits, and also NSFs or overdrafts. That's another category that could result in uh, letters of explanations, right? In the least. Business assets is another category here, and again, we're talking more about bank deposits. One of the things you are going to note when you do provide the bank statements from a business account where it's being used to meet the reserve requirement or the down payment is that you are going to be required, or the borrower is going to be required, to provide a letter from their CPA. And I use the term CPA here interchangeably to mean actual CPA, or tax preparer, or accountant. Any of those three could prepare the letter that is going to state that using the assets for the transaction, like for the down payment, closing costs, reserves, for whatever is going to be used, will not negatively affect the business operations, right? That's a critical component there. You're either going to have to provide that letter, or you're actually going to have to provide a cash flow analysis that will show that pulling that money out of the business will not negatively affect the operations. But I think it's a lot easier and simpler to get the letter from the accountant than it is to show a full cash flow analysis minus the funds in question. Now, if it is sale of real property, like a pending sale on their current primary or an investment property, or maybe a property that already just recently sold, right? You're going to have that big old $200,000-$300,000 deposit, large deposit going into their account on top of that. So you're going to verify that asset with a copy of the closing disclosure once the transaction does close, showing the net proceeds that were sent to the seller. And then there may also be some documentation required confirming that the borrower actually owned that property. I mean, it's if the closing statement is in their name and it's their current primary or a property listed on the schedule of real estate owned, that's pretty basic. But if the property is in an LLC, then you probably would have to provide some type of documentation showing that they are the owner of that LLC in order to grant them those assets. Gifts, right? So one of the main things you want to check on gifts is that you have a gift letter signed from an authorized donor. Now, what do I mean by an authorized donor? Well, depending on the loan type, and they are all different. For example, Fannie Mae and Freddie Mac categorize acceptable gift donors. There are some differences, right? Whereas Freddie Mac actually allows the gift to come from a real close personal friend, right? Fannie Mae doesn't say that. Fannie Mae has other categories, but doesn't say a really close personal friend. So that may be one reason, why you go Freddie over Fannie. But just make sure that the donor is authorized for the transaction type, right? And again, FHA is real strict. It's like relatives, or it could be like your fiance could give you the gift, but you just can't get it from a friend. So do be aware that if the donor is not on the list of authorized donors to give a gift, your gift may be rejected. And then you're going to have to provide a proof of the transfer of the gift. So you're definitely going to need a transaction history from the borrower's account showing the money entering the borrower's account and the new balance. And then you're going to have to provide from the donor either a um, wire transfer confirmation, clearly identifying who the transfer is coming from, what account it's coming from, and who the transfer is being sent to, and the amount of the transfer. And if it wasn't done as a part of a wire transfer, if it was a check, for example, then you're probably going to need a copy of that check as well as the transaction history from the donor showing that money clearing their account. So it's always best that they send it via wire transfer so you can avoid having to ask the donor to provide transaction history from their account, which they may be hesitant to provide as they are not a borrower on the transaction and may feel like that's their private information. Interested party contributions. Again, I mentioned who we're talking about here. It could be a seller credit, could be a realtor credit, could be a lender credit. Confirm that the amount is within the allowable limits for the loan program. And do be aware that, especially with investment properties, there could be limits on interested party contribution. And also depending on the LTV on an agency loan and a conventional loan, right? If it's 5%, you're looking at one limit for interested party contribution. If it's 5% down, if it's 10% down, you're looking at a different option. So do be aware that the interested party contributions do vary between agency and non-QM, and also just from loan to loan, depending on, especially for non-QM, depending on the investor chosen and depending on the borrower type, seems to be a lot more restrictive if the borrower is an investor as opposed to a primary or second home. Retirement funds is a very tricky category. So if putting retirement funds on an application, for example, to meet reserve requirements, do be aware that they may actually require liquidation of the funds that are being used to meet the reserve requirement. So again, you have to look at the guidelines if it's non-QM, or the selling guide if it's agency, to see how they're going to treat retirement funds. If the funds are actually going to be liquidated, that's not an issue. That's pretty easy, right? You're going to show the paper trail. But if the funds are not going to be liquidated, that's what becomes a little bit trickier, where you're actually going to have to provide the terms and conditions of withdrawal. If the funds were to be withdrawal, they want to make sure that the borrower can actually withdraw the funds. For example, if it's a housing hardship situation, that's one of the reasons where they would let you withdraw funds from a retirement account. So do be aware there are restrictions on using retirement funds, and if you think it's going to be an issue getting the necessary documentation, consider if you even need to include those retirement funds in the application. Sometimes we put them in there just because we want the deal to look good. Well, I would strongly consider running your automated underwriting without them, unless those funds are needed to be actually liquidate, because they're part of the funds for the cash to close and not for the reserve requirement. So do be aware of the different ways that retirement fund accounts are handled between non-QM and agency. Cash on hand I have on there only because I want to be able to state that cash on hand is not verifiable, right? If they all of a sudden go and deposit $20,000 or $10,000 or $5,000 into their account, now if it's an agency loan and the borrower makes $12,000 a month, then you'd be that $5,000 would be less than the $6,000 limit before a deposit is considered a large deposit, because they usually use 50% of their income. Anything above 50% is a large deposit, but that's for conventional, and that's for conventional only, Fannie Mae and Freddie Mac. For any of the other loans, cash on hand is going to be an issue. So make sure that you discuss all of the sources of the borrower's funds to close a transaction, and if any of them are cash on hand, so that you can review all of the available guidelines and selling guides to see how you can navigate the waters effectively to be able to capture the cash as an asset. And what we're looking to do here, one of the things you want to make sure as you're reviewing the bank accounts, as you're reviewing all these statements, is look for undisclosed loans or liabilities that may appear, right? Sometimes that'll happen and it's showing up as an auto debit on a bank statement, or it could actually even be showing up as an auto debit on a pay stub, right? So, but usually you're also going to possibly see it on a bank statement. So do look for undisclosed loans or liabilities. And again, as already mentioned, do review for large deposits or large transfers, because they may see a large transfer for $15,000 leaving the account payable to ABC Title Company, right? So what are they going to think there? They're going to think, wait a minute, there is an possible undisclosed purchase transaction here that we're not aware of. And that would be a contingent liability, any concurrent purchase that has to be taken into consideration if it's a DTI loan. If it's a DSCR loan, it's not going to be an issue. But if it's a loan where the borrower's income is being used and where DTI is being calculated, any type of undisclosed purchase transaction is going to be an issue, and is going to be documented, because there is one of the questions on the application in the declarations does ask if there's any other mortgage loans that the borrower is applying for other than the loans that they're applying for this subject property. And in our final slide here, we're discussing sourcing and seasoning of the asset. And again, in the seasoning part, we're not talking about salt and pepper. We're talking about how long has that borrower had possession of the asset, right? Has it been 1 month in their account? Has it been 2 months? Has it been 3 months? Because depending on the option chosen, if it's an agency loan or it's non-QM, you're going to have different seasoning requirements and different documentation that you're going to need to require from the borrower. Please do be aware that unsourced funds, right? So if you can't source where that big deposit came from, and it's an option that requires sourcing and seasoning of the assets, any unsourced funds will be deducted from the available assets for the transaction. So to be aware of that. So what are the common ways that we can source and season some of the more common assets in a transaction? Well, the earnest money deposit, also referred to as the EMD, or escrow deposit, that is very easily verified by either a canceled check or a bank statement. Because even if you show the canceled check, they're going to want to see the bank statement or the transaction history showing the money leaving the account. And even if you provide a wire transfer confirmation, just a separate wire transfer confirmation, not the actual statement or transaction history showing that it was a wire transfer. If you provide the confirmation, you're still going to have to provide either the statement or the transaction history showing the money leaving the account, and hopefully in the transfer it shows the amount and who it was being transferred to, ABC Title Company, so that then you will have verified your escrow money deposit. Now, if it's a new account or if it's a large deposit, you're just going to have to show where it came from. Was it savings? Was it from earnings, right? You got paid and you put the money into a new account and you can show the paper trail. Was it a gift from someone that you deposited into the account or opened a new account with? Was it the sale of an asset, or was it a loan? Whatever it may be, you're going to have to provide it if it's a new account, assuming that the option you've chosen requires you to source large deposits and also make sure that they are seasoned. If the borrower is using business assets as part of the funds to close, obviously they must be self-employed. They have to have access to the assets. If there are more than one owner of the business, you will need a funds access letter signed by the other partner or partners if there's more than one. So if, for example, the operating agreement shows that our borrower is 33% owner, or 33 and a third to be exact, owner of that business, that means there's two other partners that need to provide a funds access letter that the borrower has 100% access to the funds in business account 1234 with Best Bank in the USA Inc. Right? The business also, like I already mentioned, the business cash flow analysis must show no negative impact on the business, or preferably, as opposed to having to provide a business cash flow analysis, simply provide a letter from the tax preparer slash CPA slash accountant stating that the borrower withdrawing $52,000 from checking account 1234 at ABC Bank will have no negative impact on the operations of 123 Inc. business. Gifts. What you need to note on gifts first and foremost is, does the occupancy type on the loan even allow for gifts? That tends to be more of an issue with investment properties, even though we do have options for investment properties that actually allow 100% gift. Usually, though, in all of those cases, the gift cannot be used for reserves, but we do have options that allow 100% gifts on investment properties, non-QM. So again, does the occupancy allow for gifts? Is the gift being used for reserves? Gotta make sure you look at that one, because typically gifts cannot be used for reserves. That's usually across the board. You're not going to be allowed to use a gift for reserves. Is the donor an interested party to the transaction? There may be restrictions there. If the person giving the gift is also the seller, then you're going to have issues there possibly. So just make sure that you clear any issues with the gifts being provided by an interesting party to the transaction. And last but not least, asset-based loan, like those that you can obtain from your 401k retirement account. I previously mentioned this. The loans do not have to be counted against the liabilities as long as the 401k assets cover the loan amount. And also, it's a secured loan. So do look at the selling guide for agency loans on that, and do look at the guidelines for your non-QM loans on how to treat asset-based loans. So many different ways here to source and season assets and verify your assets. These are not very complicated things to take into consideration, but could definitely complicate your loan if you go above the limit, for example, of the gift, or if the occupancy type for the loan type does not even allow gifts, and you're restructuring the whole transaction with the gift, and now it gets to underwriting, and they suspended your loan because the borrower is short on assets. So looking forward to helping you all structure your loans and clear any asset-based questions.
All right. Thank you, Jose. I don't see any questions here. I'll give it just a second in case we have any questions come in. But definitely appreciate everybody tuning in. Definitely great topics here. Remember that we do this training at 12 p.m. Eastern on every Tuesday, Wednesday, and Thursday. So we'll be back tomorrow with a new topic for you. Still don't see any questions, so we'll go ahead and wrap it up. So we will see everyone tomorrow at 12 p.m. Eastern for the next episode of the Loan Officer Training Series with the Mortgage Calculator.